And the demand destruction we're talking about, people using less gas at this point, and we're talking about gas, the price that they're paying, gasoline, what they're paying at the pump for these things. U.S. usage down by about 8%. So that's the demand destruction. Higher prices tend to cure high prices, whether that be through the supply picture or demand. And it looks like demand that's getting cut. How long do you anticipate that will last?
Yeah, as you point out, we have seen a demand adjustment in the gasoline market, especially in the U.S. Now, keep in mind, that's a response to record high prices that have since significantly come down. We think that maybe demand weakness is actually overstated in the data. So at current retail prices that are still declining, we'd actually expect to find back some demand. Remember, this process works both ways. Now, the key question then is, has the increase in prices been enough? And our take, when we look not only at the U.S., but on a global scale, is, look, demand for oil is still above supply. And so we're still depleting record low inventories. And so the move in prices that we've seen, especially the retrenchment, effectively is slowing the necessary rebalancing. And in our view, sets the stage for higher prices in coming weeks, unless the economy is about to abruptly slow, but we don't see that happening so far.
I think that's the big question. That's what we're looking through in every earnings statement. Hearing from Verizon today, even hearing from American Express, which had great numbers for the quarter, record spending, something like 30% increases in consumer spending on their Amex cards, but Amex still taking and setting aside credit losses for $410 million for the slowdown that they're anticipating too. Things look great in the moment, but just about every company is worried about what's coming in the next 3 to 6 months. Why do you think that slowdown won't be as severe as some of these other companies are kind of anticipating?
Yes, I think there are a few points. First of all, as you stated, right, in the moment, demand is still good. And commodities are in the moment markets, right? The issue we have is today's or the very near term supply and demand, especially, as I said, in a world where we don't have the usual inventory buffer to smooth out the system, right? So if in the moment demand is still good, and that's what we find when we look across countries and across forms of demand, and that's today's challenge. That's the case historically in a recession, right? Think about 2008. We were beyond 6 months into the recession and oil prices were still rallying to record high. Because the issue there is not about future growth rates, it's about today's imbalance. Now, eventually, of course, if we do have a sharp slowdown in economic activity, of course, this will help for some time resolve the oil deficit. But I think there are two challenges here. The first one is, that's still not guaranteed. Sure, there is a slowing growth, tightening financial conditions, but so far, our view is the odds of recessions are still below 50%. Second, even a recession, if it occurs, hasn't resolved the energy shortage that we face. This is a decade in the making, a decade of underinvestment. And if you slow demand through tightening of financial condition, as soon as you pull that restraint back, demand recovers and you're exactly at the same constraint on energy. So I think that's the second horizon, right? There's the short term, we think, higher move in prices, but there's also a multi-year move here, which is sustain likely record high prices to finally get those trillions of dollars of investment migrating. In fact, compared to 2008, right, we had record high prices after 10 years of investment in oil supply. Today, we may end up with record high prices after 10 years of underinvestment. The challenge is much greater from here.
Yeah, I would also say what you talked about, just these commodity markets living moment to moment and seeing these huge swings. I mean, we are 2 years out from a time when we saw oil prices go negative. We've watched them jump at well above $100 a barrel. And that's a really difficult environment to try and convince energy executives to start spending billions and billions of dollars for additional production. When you see these crazy fluctuations, bigger swings than we've ever seen, and nobody had ever seen oil prices go negative before, is that something that is going to make it even harder and take longer to get them to invest more money back in, that and the ESG backdrop that you have?
Yeah, I think those are very important. We tend to think of the world of investing under uncertainty in energy markets. And that uncertainty is record high. And I would actually lay it out in two different ways, right? You have the actual fundamental uncertainty, right? Chinese demand, Russian supply, potential recession. Then you look 2 years out, the pace of the energy transition. Second, given all those concerns plus record low inventories, you have price volatility, right? Extreme price volatility. So then if you're trying to budget for billions of dollars of investment, you have to naturally be cautious in the face of this uncertainty. In fact, the price uncertainty and the price volatility itself reduces your ability to hedge, and as a result, again, pushes you to be more cautious than historically would be the case. And I think that's a key challenge, right? Ultimately, you were talking earlier about Uniper, right? That's when governments need to intervene, is when the uncertainty is so high that it prevents investment. You need measures to help support investment to avoid what is really the worst possible outcome, which is ultimately stagflation, right? You never invest enough in energy supply to actually allow economic growth to resume and normalize, right? That would be the main risk here following this underinvestment crisis.
I mean, it goes along with global economic swings like we haven't seen before, too. The COVID shutdown. Those are the things that are so hard to plan around. Are we convinced that this is going to be maybe a more normal recession that we see this time around? Because that's what it would take to keep oil prices high.
Yeah, so that's, I mean, what this recession will look like, I think is a key challenge. I mean, on the one hand, if you compare it to history, what stands out? First of all, we're heading into a potential recession, not our base case, but with tight commodity markets. Historically, such recession, if they occur, tend to see sustained high commodity prices. Second, maybe the systemic risks in the system are not as great in 2008, 2009. So when you put those two elements together, sure, a recession is not a positive for commodity prices, but we may not go to $30.
Steep, it's not a big deal, right?
Yeah, we won't go to $30. But again, that concern, though, as you mentioned, is reducing investment today. And I think that's really why, even if in the short run prices remain volatile, on average, they will have to remain high. Now, the last point I would make to kind of how do we square all that? What's our guiding kind of metric in the very short run? Right. It is one of record high physical prices relative to the Brent that you see on the screen, right? That physical premium is unprecedented. That's symptomatic of that tightness today and why, in our view, the next move is higher from here.
Damien, thanks.
Of course.